Good morning. I'd like to thank the Mexican Insurance Association for inviting Fitch to speak at its annual event. The topic on the agenda for today is Insurtech, more specifically, technology, innovation, and insurance company ratings. Insurtech refers to the use of technology innovations designed to squeeze out savings, increase efficiency, and improve performance in the current insurance industry model. Insurtech, like fintech before, has been a high-profile topic in the insurance industry in recent years. Many have said it has the potential to disrupt the current insurance model. But technology innovations have been a hallmark of the insurance industry long before the term Insurtech was coined. Computer and other technological advancements have changed the way insurers operate for the last 100 years. But what's different now? The difference in my mind is the velocity of innovation. Change happens very quickly. The life cycle of the technology and even industries has shortened. If you think back to the BlackBerry device, 10 years ago, just about every business person I knew had a BlackBerry. The product began in 2006, peaked in 2011 with sales of more than 50 million devices in the US, and was virtually gone by 2016. So here was a blockbuster innovative communication product that came and went in the space of 10 years. Competing products like the iPhone evolved to capture the business market. So the BlackBerry advantage was very short-lived. So what are some of the innovations impacting Insurtech today? Well, things like artificial intelligence, machine learning, the Internet of Things, wearable technology, drones, and yes, even smartphones. A recent article by Willis Ree said 2020 is the most important year for Insurtech to date. COVID-19 tested the insurance industry's digital capabilities, and the industry largely passed the test. The ability to operate and function remotely could only be done with the help of significant technological advancements. Had the pandemic come 10 years earlier or even 5 years earlier, the story would have been much different for both insurers and for many industries. So in addition to how 2020 tested the insurers' digital capabilities, the year also saw large Insurtech IPOs, other capital raising efforts, and some Insurtech companies did not even survive the pandemic and the shock to the economy. But the broad success of insurers operating through a pandemic has increased the appetite or conversely reduced the fear of aggressively moving forward with technology. So our focus is less on Insurtech companies per se, but on how the technology is impacting the insurers we rate. Insurers spend a lot of money on technology. I remember one CEO telling me a number of years ago, they spent an unlimited budget. They overspent an unlimited budget on technology. Some insurers are on the leading edge, and others are fast followers, and still others are very slow to embrace new technologies. We're often asked as a credit rating agency, what's the best strategy? And the answer is really that for each of these strategies, leading edge, fast follower, slow adopter, can be successful or it can be a failure. There's really no right answer. It's really how the insurance company executes on their chosen strategy, and execution is very difficult. One of the biggest challenges I think that's out there is that technology people and insurance people don't often speak the same language. And I don't mean English and Spanish. What I mean is that technology types may not understand the inner workings of an insurance company, including the laws and regulations. Insurance people are experts at these, but may not necessarily be innovative. So again, they speak different languages, they look at industry issues through their own lenses. Technology can be very innovative, but not necessarily solve the insurer's problems or advance the insurer's business. Sometimes really cool technologies may be the answer in search of a question. Companies on the leading edge, or sometimes called the bleeding edge, may not get the value they envision. And the cost is not just money, but also opportunity costs and management time. The senior management at insurance companies need to better foster idea sharing, cooperation, cost management for Insurtech to have its greatest impact. If done right, however, technology could lead to a first mover advantage for the insurer And in the US, some early adopters of technologies like telematics for underwriting automobile insurance policies were able to generate industry-leading results for many years. So the same success or failure can be found for both fast followers and slow adopters. Again, executing on the technological innovations in the market is the key to success. Now, what are the rating implications? From a rating perspective, the success or failure of Insurtech for an insurer will ultimately be exhibited in two of the key credit factors in Fitch's insurance rating criteria: business profile and financial performance. Business profile assesses the combination of competitive positioning, business risk, and diversification. Technology success or failure can impact these subcomponents of business profile, things like service and distribution capabilities, operating scale, breadth of product offerings, risk management capabilities, ability to expand into new markets, and so on. Financial performance is the ultimate scorecard. The success of a technology initiatives ultimately should show up in financial performance. We once rated an insurer who boasted about their innovation and their leading edge technology. And every year they would talk about how they're investing in the business and all the great things they're doing with technology. But they continuously generated poor financial results. And our view, again, is that at some point, the fruits of these investments must show up in the numbers. For this company, they never did. And that told us that their technology strategy was poorly executed. To date, Insurtech is most advanced in what we call in the US property and casualty insurers, also known as general insurance or non-insurance or non-life insurance, depending on the market. Particularly personal lines P&C companies that sell auto and homeowners insurance. But in recent years, it's expanded also to commercial lines P&C space. And an important contributor to these efforts for P&C companies is telematics. And this is the convergence of technology and information processing. Telematics is not a new technology, but data generated from telematics devices is the single most predictive indicator of loss. Telematics also eliminates any perceived or actual bias from socioeconomic or ethnic information, as data is from the insured's actual driving metrics in the case of automobile insurance. Despite being an established technology, many insurers are further refining the data captured by devices to make their data more predictive. And there's a clear differentiation in retention and profitability for policies that are underwritten with telematics. Now, what about life insurers? I would say generally life insurers have trailed other insurance sectors. Life insurers have complex legacy computer systems that evolved over many decades. Historically, technology emphasis by life insurers was simply to keep the business operable by installing patches on their legacy systems. Now, as life insurers think more about Insurtech and their next technological leap forward, the key focus should not be on integrating older systems with those currently under development, but rather to implement migration schedules to new systems. And this will allow life insurers to maintain access to clean data that influences more dynamic decision-making capabilities. The life insurance industry has a history of aggressive product innovation and pricing that often leads to problems down the road. The increased use of automated underwriting remains dynamic, and data-centric safeguards to ensure that experience remains aligned with that of human underwriters. That's the goal, but I think it will take many years for this to see how successful these efforts have been. Over time, as insurers better harness the use of data in underwriting algorithms, the goal would be to better predict anti-selection and poor underwriting risks. However, for now, primary writers continue to rely on third-party reinsurers to limit financial losses associated with poor experience derived from automated underwriting. And third-party insurers' analytical expertise in understanding risk assessment and mortality, and risk segmentation and mortality of various cohorts plays a really important role in risk management and underwriting processes for primary writers. As the industry shifts from its simplified offerings to more data-driven underwriting, third-party reinsurers will continue to play this role, we think. Privacy concerns. The insurance industry's focus on attaining more granular data to better segment and price products creates privacy and personal information protection concerns for consumers and regulators. All life insurers are focused on mitigating the risk associated with the improper use of personal identifiable information. And more specifically, the industry has worked with various counterparties, including regulators and legal counsels, to ensure that policyholder data is protected and not used in a discriminatory manner. But the risk of cybersecurity breaches exists and cannot be ignored. I guess in conclusion, I'd say that the technology and innovation is causing significant change in all aspects of the insurance industry. An individual insurance company's ability to harness the power of technology and successfully execute their strategy will determine the winners and losers of the future. For Fitch as a rating agency, the scorecard for these results will be largely found in two of our assessments of key credit factors: business profile and financial performance. So thanks again to the Mexican Insurance Association for the opportunity to speak with you today.
Good morning. Thank you for inviting me to talk to you today about the U.S. cyber insurance market. Going back a little bit, trying to find the history of the cyber insurance market, many industry participants trace the origins of cyber insurance back to the mid-1980s when underwriters wrote E&O tech policies. However, the pace of tech has changed dramatically since then and continues to do so. In 2003, there were about 508 million devices connected to the internet. In 2012, there were 8.7 billion devices, a 17-time increase in 10 years. Research from Cisco stated that there will be 27.1 billion devices connected to the internet in 2021. That's approximately 3.6 devices per person with a world population of 7.6 billion people. That's a 3 times growth from the 2012 figure and a 53 times growth since 2003. The point is, these devices are proliferating at a very alarming pace for 3 reasons. First is the high-speed internet becomes more available throughout the world, both landlines and wireless technology like 5G. Second, devices are becoming cheaper. Third, more people want a connected life, a place where you can control your TV, thermostat, lights, and coffee maker from the convenience of your phone. According to recent research from Ookla, the average download speeds have also increased dramatically. In 2009, it was 5 megabytes per second in the US, and a mere 9 years later, it was up to 96 megabytes per second. That's a 20-time increase in over that time frame. With 27 billion devices connected to the internet, that means 27 billion devices need to be secure and updated, otherwise a potential cyber incident may occur. Often, it's very expensive with the latest to keep up the latest technology and trends, particularly as the number of devices increase. All this is a quick background to say that historical data is not necessarily following the trend line. Technology can and continues to explode at an alarming pace. In 2014, the National Association of Insurance Commissioners, the NAIC, appointed a cybersecurity task force that created a standard cyber insurance disclosure form that all filers have to fill out if they write cyber insurance, starting with year-end 2015 data. This form has remained unchanged since then. It gives us a glimpse into the cyber insurance market in the US, the best glimpse we have. But this form has one major flaw. Not all cyber premiums are captured for 2 primary reasons. First, silent cyber insurance, and second, package policies. Let me talk a little bit more about silent cyber first. Silent cyber is when the policy does not specifically endorse or exclude cyber events. This leaves the company susceptible to aggregation of cyber event losses and that premiums did not consider. Silent cyber may also arise if the policy language is ambiguous or conflicts with other policy wording. As a side note, the COVID-19 pandemic also highlights the importance of policy language and exclusions. 2 quick examples of silent cyber insurance I can give you. First, if a property policy covers material damage and business interruption from physical loss or damage to a tangible property, standard. However, what happens if there's a malware attack in a programmable controller that leads to a fire in a production facility? Is that covered by the property policy? Or take directors and officers insurance coverage that provides coverage for litigation or regulatory actions arising out of a failure to disclose, misrepresentations, or breaches of fiduciary duty. What happens if a publicly traded company experiences a data breach, ultimately leading to a stock price drop and a securities class action lawsuit? Is that covered? In 2019, the UK Prudential Regulatory Authority was amongst the first regulatory bodies to challenge underwriters to more effectively manage affirmative and non-affirmative policies. Two large companies publicly stated they were going to actively reduce silent cyber exposure from this, Lloyd's of London and AIG. The second thing that kind of impacted these policy forms that we talked about was package policies. So let me talk about that now for a minute. Form asks the question is, if you write a package policy, can premiums be quantified or estimated? If the answer is no, the form then stays silent for the rest of it. So you have to be able to quantify that impact from it. This quirk, along with silent cyber, underrepresents the true cyber insurance market. Nonetheless, back in 2016, Fitch was the first to aggregate the NIC data into a special report, and we continue to do so for every year. Year-end 20 data is not quite available yet at the time of this airing of this, but will be available shortly, and we'll comment more on it publicly soon. But from the year-end 2019 report, let me give you a couple highlights. Direct written premiums were $2.3 billion, up 12% from the prior year, or 2.3 times larger than the $1 billion reported in 2015. The top 5 writers of the standalone and package policies were Chubb, AXA, AIG, Travelers, and Beazley. Those 5 accounted for 51% of the consolidated market in year-end 2019. Breaking the premiums down between package and standalone is a little bit more interesting. From 2015 to 2019, package premiums almost doubled, with direct written premiums of just shy of $1 trillion at $986 billion. For the same time period, standalone cyber almost tripled to $1.3 billion in 2019. Growth in the standalone cyber market is an insurance credit positive from Fitch's perspective. Top 5 writers of the standalone policy were AXA, AIG, Travelers, Beazley, and Fairfax. They accounted for almost 2/3 of the market. In terms of the loss ratio, the 5-year average direct loss ratio for 2015 to 2019 was 41%, and at year-end 19, it was 47%. It's a fairly profitable line of business with significant growth, which has led to Fitch's concerns about naive capacity entering the market. Data breaches were the leading cause of loss, but ransomware started to become very prominent in 2018. Now let me leave you with some predictions, since we don't quite have year-end 20 data available. Fitch expects that premiums will continue to grow significantly as cyber insurance demands increase. Loss costs are increasing at an alarming pace, and rates are continuing to respond in kind. A recent Aon survey indicates that rates are likely to increase 20 to 50% from last year, depending on loss severity. We continue to expect that standalone cyber products will increase and silent cyber will continue to decrease as companies exercise caution in cyber aggregation, particularly with loss costs increasing. There will also be a challenge in modeling cyber losses and cyber aggregations, as it's difficult to model this risk. This will lead some companies to quickly enter and exit the line depending on market conditions and may be volatile year over year. As losses continue to increase, the cost of cyber reinsurance will increase in kind, making it more expensive for insurers who heavily rely on the reinsurance product. And lastly, regulation will lag, but will address cyber risk, driving the demand higher for insurance coverage ultimately. We thank you for the opportunity to speak to you today.